Hey guys, it's Rudy coming at you live from Palm Beach in Florida. It is Friday. It is May the 2nd. We're getting close to the middle of the year, and I'm getting close to catching up on the homework that you guys gave me on the channel in the chat sites and the comment section and all that kind of stuff. So what we want to do now is answer the big question from Wild Saddle, which is coal. He said, "Can you do another video on clean coal?" So this is the video on clean coal. Clean, of course, being somewhat arguably a misnomer for coal, because coal is also considered to be dirty and environmentally not friendly and all that kind of bad stuff. But in reality, it powers the world. So where does coal come from? So in the first place, raw materials deposited 100 to 400 million years ago. Nobody really knows the answer to this question. 100 to 400 million years ago is such a wide range. Basically, that just means we don't have any idea where this natural resource came from. And then, of course, it says compressed and heated for millions of years and shows you pictures of little dinosaurs and all kinds of stuff like that. There's no such thing as fossil fuels. It's just a term that they used in order to insinuate and imply that we're going to run out of it sooner than later, which isn't the case. In fact, most of the coal resources on the planet have not even been discovered yet. So no worries there. This powers the earth. Extracted and used and converted to electricity and delivered via the grid. This little picture is from the Freeing Energy Project, which might or might not be a green site. I don't know. I don't really care. I just like the picture. Wild Saddle gave me this little challenge and he said, how about another clean coal video? Monish Prabhai seems to have all his American investment funds in primarily three stocks, HCC, AMR, and CNR. Has he figured something out? Does he know something we don't know? Of course, arguably, he's much smarter than all of us, so maybe he knows something we don't know. He seems to be significantly down, at least for now. Anyway, IMO, in my opinion, says Wild Saddle. Now, it's important for you to know that all coal is not created equal. There are primarily two types of coal. Metallurgical coal is mainly used for the manufacturing of steel, and thermal coal is mainly used for electricity production. Thermal coal being the sort of less pure and less good quality of the two. Metallurgical is the best that you can get. What is it used for? Well, as you can see in this big blue pizza pie slice here, electricity generation, nearly 70% and 7% steel manufacturing, and then some other industry and other applications too, like cement plants, 4% heating, 3%, and so on. So coal is used in a variety of different ways, but primarily thermal coal is used for heating 70% of the earth. Now, let's take a look at these five stocks, right? So what I've done is I've taken the three stocks that Wild Saddle has challenged me with, which is AMR, Alpha Metallurgical Resources, and CNR, which is Core Natural Resources, and HCC, which is Warrior Met Coal. And I dumped them into a bar charts comparison of five different stocks and added two of my own. One of them is Alliance Resource Limited Partners, which I own and which I have been long in for some time, and it's one of my largest positions. And the other one, Peabody, which has been a favorite for coal investors for a very, very long time. But I'm not sure it's a favorite anymore because it is down just too much and people don't seem to like it anymore. Anyway, so if we look at these five different stocks, it's important to note that all stocks are not equal. Now, in the first place, as I just mentioned a minute ago, there's a difference between metallurgical coal and thermal coal. And in this particular instance, we have two of them, Alpha Metallurgical Resources, Inc. and Warrior Met Coal. So the bookends of this five rows and columns that I'm going to show you on either side are metallurgical coal companies, and the three in the middle are thermal coal companies. The other one that's the odd one out, which I also added a red arrow for at the bottom here, is Alliance Resource Limited Partners. It is a limited partnership, which means that if you invest in Alliance Resource Limited Partners, you will receive a K-1 form because you are a partner in that partnership. And when it comes to tax filing times, you will have to file your taxes as a partner, which is almost as if you had worked for Alliance Resource Limited Partners, even though you were a passive partner in the equation. Now, the first thing we're going to look at for the technical gurus among us is the 20-day raw stochastic. And you will know from previous videos that I shared with you that if the 20-day raw stochastic score is above 80, it is hopelessly overbought. And generally speaking, if it's below 20, it is hopelessly undersold. Now, oversold. Now, what we have here is a 20-day raw stochastic, which is pretty much all of them except for Warrior, Metco on the far right hand side, 80% or more, which means all of them are overbought. And now is probably not a good time to buy them if the 20-day raw stochastic is the benchmark that has the most importance for you in terms of whatever your investment thesis might be. Now, the fact that there's a little space here in terms of Warrior Met Coal because it hasn't hit 80 yet is kind of irrelevant because they're all trading at a similar level if you look at the 20-day raw stochastic score. Now, the analysts, who are obviously much smarter than all of us, are basically saying you should sell all of these except for Alliance Resource Limited Partners, because this one is the only one that the analysts raised as a buy. Today's opinion, which is as of today, May the 2nd, is pretty much the same across the board. Sell them, except for Alliance Resource Partners, which has a 72% buy rating on it. When you see something like this as an anomaly, you should say to yourself, like, if all the analysts are saying this is the only one to buy, maybe that's the only one to sell. It has been on a tear lately, so maybe it's time to take some profit. Conversely, if 88% of the analysts say sell, it might be a good time to get in and to open a new position. I don't know that for sure, and you might not know that either, because you need to do your due diligence and make sure that you understand exactly what it is that you're investing in if that's what you decide to do. However, we should look at the price earnings ratio. TTM means trailing 12 months, because the PE ratio arguably is a much better indicator for us in terms of what the stock is actually worth, in terms of how it's priced, compared to, say, the 20-day raw stochastic score. And here we have a very, very nicely priced range of stocks, with the exception of the one on the far right, which is Warrior Met Coal, and the PE ratio of 22. Right now, the S&P 500 is sort of averaging 15. So if you can get in below 12 or 13 or so, you're doing well. And all the other four are below that. In fact, even the one that the analysts are saying you can buy has the highest PE ratio at nearly 12. However, the other three, Alpha Metallurgical Resources, Peabody, and Core Natural Resources, are super cheap, price to buy, and perhaps even a screaming buy based on the PE ratio. But that's not all we can look at, right? Another thing we can do here is look at the market capitalization. Market capitalization, in case you've forgotten, is the total number of shares multiplied by the stock price. So obviously, as the stock price goes up and down, the market capitalization goes up and down too. What I've done here is I've done a very simple little back of the envelope math for you, and I've taken effectively the market capitalization of the company. And this, you need to add three zeros. You'll see there's a little 0K there. So this is 1.58 billion. And I divided that by 2.9 billion in annual sales, and I end up with 53%. This is fairly normal. In other words, if you get a percentage like this, this is probably arguably quite normal. However, there are abnormalities, right? And sometimes these are good or these are bad. And what you have here, in fact, even though the math might be normal, is you have a company that is generating almost $3 billion worth of sales, which has a market cap of only $1.5 billion. In other words, the value of the company is less, or about half of what its current annual revenue is. And if you look at the annual sales of Alliance Resource Partners, one of my favorites, you'll notice that it's generating $2.4 billion in sales, and it has a market cap of nearly $3.4 billion. Now, arguably, that is much more normal. Now, I've highlighted these three in green because they have the same kind of math, right? So here I have a company that's generating, for natural resources, 2.2 billion with a market cap of 3.8. And this company is generating 1.5 billion and has a market cap of 2.3. And here's another anomaly which looks really, really super cheap. Peabody Energy is generating $4.2 billion in annual sales, and it's got a market cap of only $1.5 billion. So if you look at it from a price to book, or sales to book point of view, sales to market value point of view, you can find there are some anomalies here that might or might not be good, depending on where you think it would be headed in the future. One thing we don't like to see in the case of Alpha Metallurgical Resources is a negative quarter net income, minus $2.1 million in negative net income. There might be a particular reason why. They might have had, for instance, a tax obligation that was due or something like that, which pushed them into negative. But we don't want to see any quarter with negative net income. I mean, otherwise, it's just not that good a business. So I'm less interested if they are running quarter over quarter with negative net income. If we look at it in picture form, which many people prefer, over a 1 year period. So what I've done here is I've taken a 1 year chart for all five of these. And the only one that actually looks reasonably decent is Alliance Resource Limited Partners. If you also take into consideration the fact that Alliance Resource Limited Partners pays a dividend of over 10%, this over 1 year effectively then generates around 24, 25% in total investor return. The others look not so good, right? So regardless of what the dividend value is, when you get into the negative numbers here, like negative 41, negative 54, there's just no way to use the dividend even as a hedge against the crashing stock price. The reason why I added this big green arrow here is because you can actually see, if you follow along, the trajectory of the different stocks are actually almost the same, other than for the fact that the price is different. With the exception of this blue line, Alliance Resource kind of flatlined while everything else took a dip, right? So we don't know exactly why that is, but what I can tell you about Alliance Resource Limited Partners is they make excess electricity, in other words, more than what they could actually sell. And as a result, they actually have more electricity available than what the market needs. And they use that to mine Bitcoin, which means they can actually mine Bitcoin quite inexpensively. And they have about 234, 200, maybe 230 to $270 million worth of Bitcoin on hand right now, according to the balance sheet. Now, just in terms of sharing some propaganda in terms of coal with you, this chart that I've got here is from an impeccable source, the U.S. Energy Information Administration, who are the kings of propaganda when it comes to green energy and related nonsense. And what they've done here is they've said the retirement and planned retirement of coal-fired electric generation capacity gigawatts. But I had to go back a few years because I'm using the chart that basically ends in 2018, and the light blue lines are planned retirements. So they had suggested that by 2018, they would start retiring some coal-fired electrical generation capacity in gigawatts. And by 2019, it would be even less. And by 2020, it would be gone. Well, that's what they predicted. And much like Al Gore predicted that the ice caps are going to melt and that places like Florida, where I'm currently making this video from, would be underwater by, I think it was maybe 1995 or 2010 or whatever the bullshit was. I don't remember. But anyway, here we are, and none of that actually happened. So what did happen? Well, this happened. I'm using the data source here, which is from Ember 2024, the Energy Institute, and they can show, and as you follow along on this little line here, that the usage of coal has gotten steadily more and more and more. In other words, it's increased. That cutoff I just showed you was sort of at around 2018. And since then, we've used a little bit more every single day, a little bit more than the day before, and the day prior to that, and the day prior to that, and the day before that, and so on and so on. And I would get tired if I go all the way back to 2018. You can also see an uptick for gas. It's also grown. You can also see that nuclear is pretty much flatlined, and it shouldn't be flatlined. It should be growing because it's safe, efficient, and highly effective as a means to power electricity. Hydro has kind of remained static, more or less, and the rest of the garbage at the top of the chart here don't really matter much because they are relatively insignificant. Um, if the wind blows, sometimes it blows the windmills over. And if the wind blows and the windmills are actually, the turbines are actually turning, then they kill birds and they just make the landscape look ugly. There's nothing here that is pretty good. In fact, the worst one of the lot is probably bioenergy, because that means let's burn down trees in order to make electricity. But this is what actually happened compared to what the US Energy Information Administration predicted was going to happen. So that was their wish list, and this is the fact in terms of what actually happened. So let's take a quick look at each of these individually. So I'm just going to go through them very quickly. Alpha Metallurgical Resources, ticker symbol AMR, trades on the New York Stock Exchange. You can buy it for about $126. That was today at the close. And year to date, not year to date, but for 1 year, it is down 60%. So this stock has pretty much just been on a steady decline, and it has just crashed. Now, as I said it right at the beginning, some investors know better than us and they are significantly smarter than us. So maybe uh, people like Wal Saddle's reference there know something we don't know, and maybe now is a good time to get in. I'm not confident about that, but let's look at the information at the bottom of the screen here. The PE ratio is only 8.88, right? So that looks to you like this is a screaming buy. You're not going to buy it for its dividend because it's not worth it. This is definitely not much of a hedge at all. But look at this 1 year target price, right? So currently it's trading at 126, and the 1 year target estimated price is 183, which is about 50% up from where it is right now. Now, just today, it was up 4.5%. So if it turns, it can turn quite quickly. I'm not sure. I'm not confident because I don't know about this one, and I certainly have not done a deep dive on it. And I suggest you would do that. You should do that if you want to buy into Alpha. How about Alliance Resource Limited Partners? So this is the one that the analysts are basically saying buy. ARLP, remember it's a limited partnership, so you're going to be a partner and you're going to get a K1 for your tax filing. You can buy it as of the close today at around $27. Year to date, it's up 18%. And if you look at the dividend over here, you could buy this one as a dividend hedge because it's nice. It's 10% uptick you're going to get regardless of whether the price goes up or down. But right at the bottom in the right-hand corner, it says the 1 year target estimate price only $30, right? So there's only a potential 10% upside on the price. So effectively, this is something that you hold. You wouldn't buy and open a position right now. It's trading sort of near its high or near its estimated 1 year target. And if you already hold it in your account, you just hold it. If you're up a lot, you can always sell some and take some profit. But I wouldn't open a new position in Alliance Resource Limited Partners right now. The PE ratio 12.75 is decent. It's not a screaming buy. Peabody Energy, on the other hand, is a screaming buy with a PE ratio of only 4.69. The dividend is basically nothing, and the 1 year target price is 21 bucks. It's currently trading at $12, right? So there's a 50% upside here as well. They had a nice day today. You can buy it on the New York Stock Exchange, ticker symbol BTU, for $12.85, and it's down 40%. So where's it going from here? You tell me. Is it going to go down more? Can you buy it perhaps below $10? That would be a steal. Or is it going to go back up from here? I don't know. Peabody was the coal favorite for a long, long, long time, but not anymore. Core Natural Resources trading at $74. It trades on the New York Stock Exchange, ticker symbol CNR. Um, Today it was up 4%, but for 1 year it's down 9.86%, so almost 10%. Not too bad, because many of the coal and energy stocks are down much more than that. Again, you're not buying it for its dividend because it's not worth your while, but it's trading at $74. It's still got a target price of 110, so another 50% upside here, and a PE ratio of only 7.7, right? So this is possibly a steal. This could be a buy. I'm not sure, but certainly everything about it looks good at a snapshot, sort of at a glance. Warrior Met Coal, HCC, ticker symbol. On the New York Stock Exchange, you can buy it for $47.40. Over the past 1 year, it's down about 27, 28%. Its dividend is also relatively meaningless, but the 1 year target price 65, which again is, 40, 50% up from where it's trading right now, but a horrible PE. The price earnings ratio is 24. Now is not a good time to get into HCC. If you're interested in Warrior Met Coal at all, you can stick it on your watch list, but I wouldn't put it anywhere other than just on your watch list. So, what is happening today in the world, regardless of what the IEA says? So, as of 2023, which is the last full year that is reported on, coal was used for electricity production. 35%. It's the largest component to producing electricity, followed by gas at 22, hydropower at 14, and everything else is relatively insignificant in the greater scheme of things. So you can see by far, most electricity in the world is produced by burning thermal coal. So if you want to invest in anything at all, thermal coal is almost like a proverbial no-brainer, right? And why is that? Well, this is the primary reason why. The dark spots on this map of the world that I'm showing you here are the countries that burn the most coal in order to generate electricity. Now, down here at the southern end of the African continent, you have the country of South Africa, and just to the north of that is Botswana, and just to the northwest of that, northeast of that is Zimbabwe. These guys burn a lot of coal, but there's not a lot of people here. In total, the total population here is less than 100 million, all combined, right? Morocco is this little blob up here, same thing. Not a lot of people, but this is where the big play is, right? So in the world today, the Asian continent, and especially China and India, collectively house more than half of the world's population, and they are absolutely, utterly reliant on coal. If you use this color coding to sort of map this area over here, you can see that those countries, especially India, which is very dark, and then China, sort of more reddish, rusty colored, 60 to 90% of all electricity generated is done with thermal coal. And that is the reason why thermal coal and coal in general has been such a good investment, with the exception of a few outliers like Peabody, which is just out of favor. But in general, it's almost like in the same way when I do just a generic video on energy, and I say every single day, we use just a little bit more oil than what we used the day before, and the day before that, and the day before that, and the day before that, and so on, right? So currently we use approximately 104 million barrels of oil per day. That's what we're consuming. That's across the board, like for everything, about 104, right? So in about 10 years from now, 20 years from now, that's going to be like 105, 110 million barrels per day. In other words, it's not going to 90 or 85 or 80, and it's not going away. We use a little bit more every single day. Coal is almost the same. Over time, obviously, there can be a shift. And we may see that despite the fact that China is literally just building coal-fired plants hand over fist. I mean, they're churning them out at a rate of like 50, 60 per year. Um, so they're going to be burning a lot of thermal coal for the next, I don't know, generation. But even if it gets depleted somewhat, the switch then just moves somewhere else, like to natural gas or nuclear or something like that, right? So in terms of where we are right now, this is almost like a proverbial no-brainer. The challenge is to pick the right stock at the right time to get into the market and then just to hold it. And some of these five stocks that I just shared with you might be the right time now. Alliance Resource Limited Partners might not be a good stock to open a position with right now. And HCC, probably not, because the price earnings ratio is out of whack. But the other three, that's a possibility, right? But anyway, those are my thoughts on clean coal, wild saddle. Now over to you guys. You can help me out here and let me know what you think in the comments, and we'll get the conversation started. Thank you. Thanks for watching. Bye-bye.